So are we entering a housing danger zone? Is there frothiness in most markets? To help us answer that, we're joined by global real estate developer and expert, Richard Nassimi, founder of the Nassimi Group. Richard, thanks for joining us. Good to have you this evening.
Thank you very much for having me.
Richard, you've looked at the report.
Yes.
You have been in the real estate market globally and, of course, in the US. And UBS is warning that London is at risk of a housing bubble. What do you say to that?
It's not a real surprise, honestly speaking. The signals were all over there. It's been in the past year growing and growing and growing. Don't forget that London, it's basically supporting Europe, is the only economy in all, not only in real estate, leading the continent. And right now, all the investment coming all from abroad, a big percentage, well over 50% of capital are like called fright capitals, coming from the Middle East, from China. They're all pouring inside London, increasing the percentage of all the demand in real estate. Local economy is not doing great numbers nowadays. The currency for the Eurozone is at the lowest level. These are all signals moving against the economy there and the real estate.
So what would cause the shift of balance to change? What would then cause all of these international investors to want to pull money out and perhaps trigger a bubble?
Well, the instability from the country, the origin country, it's pouring out this money into safe havens, which is exactly London. But the interest rates, in order to slow down and help the local economy, should maybe have a little slight increase, because with all these low rates, it's like calling for investors to come and invest more and overstretching themselves.
Well, if you look at a UK government bond, that's yielding about, at the top end, 1.8%. And rent is yielding an average of 5%. So it's obviously very tempting to buy houses and then rent them out for income.
Correct.
And now the Bank of England is trying to get regulation to limit house purchases on the buy-to-rent aspect. Should it do it? Can it do it?
It's very hard to control it. Don't forget that, England and London is a very capitalistic, call it, economy. You can't restrain, you can put some imposition. You will not really benefit, because right now a big percentage are investors. Investors are pouring money because the very favorable yields are helping them doing the investments. If you take away the yields, there will be no more investments, and the local economy would not help it.
So if the London market does burst, what would the consequences be?
Well, that's the beginning of, I would say, quote unquote, again, real estate tsunami. You remember 2008, Washington Mutual, the crash, the collapse that hit the wave from New York, the epicenter, and hit all the world. Well, that's a signal. I don't think London can give that kind of waves to the world. I think it all starts from New York and the United States of America. However, London, especially Europe, can be the first signal.
Well, you mentioned Europe, and according to UBS, Amsterdam is rated as the second most susceptible city on the continent to a housing bubble. Why Amsterdam?
Amsterdam, in the Netherlands, in 2015, Q1 and Q2 had 23% increase in real estate price. 23%. That's a huge increase. And the market itself is not growing at the same speed. Don't forget that right now, the inventory, even in Amsterdam, was at a low level. So that helped a lot. But going at this pace, Amsterdam cannot support this kind of figures. It has a huge increase.
Well, UBS and Deutsche Bank actually judged U.S. real estate to be fairly valued, even in New York. San Francisco was an exception. Do you agree with that?
I agree in some part. New York, as of right now, price per square feet is not comparable to the famous metropolis, like Hong Kong, London, even Sydney. It's at the lower level, price per square feet. And it's the most safest haven you have around the globe. San Francisco is being helped by the tech. I would call it the tech bubble. Until it's there, they're going to be okay. Price is going to surge. Once there's some problems in the tech, I don't know.
So with these low interest rates in the U.S., are you surprised that we're not seeing more overvaluation here in the U.S.?
That's what's actually doing the overvaluation for the local purchasing. It's the low interest rates. Everybody's taking advantage to refinance, to take equities, to borrow money. Borrow money right now, it's the lowest level. This was to help after 2008. The Lehman collapse was to help to spur the economy. We didn't touch it so much.
But it feels like we're back to square one. Are we about to repeat ourselves? The economy needed stimulation, interest rates were cut, housing markets were boosted, and now there's signaling that the Fed and other central banks may tighten. So, Richard, how should this be handled?
Again, it's a very difficult situation because on the other hand, you cannot increase dramatically the rates. If you increase them, you stop the economy, you stop the bank, you stop everything. So it must be a very slow, gradual increase of rates. But you cannot hold them like this forever. It's quite impossible. You're gonna keep going on a certain level, and the bubble will burst.
Well, you seem to be in agreement with UBS that big warning signals flashing ahead.
That's 100% correct. It's just a question of when.
Okay, just a question of when. Timing is everything. Unfortunately, we're out of time with you, but thank you so much, Richard Nassimi, founder of the Nassimi Group.